Hello, welcome to our video. Today we'll explain how to apply the correct tax strategy to help retiring jazz musician Carl Freeman to plan for a happy retirement. For a starter, retirement planning can be complicated, especially for small business owners who have to balance both corporate needs and their personal needs. There are a few questions you have to ask yourself when planning for retirement. What is your timing like? When do you want to retire? What are your needs? How much do you need to save? And what kind of lifestyle do you want to live in retirement? And the risk levels which you can tolerate. Where should you save, and what are those instruments that will help you to reach your goal? There are some tax implications to different styles of savings. Shifting income from one time period to another, commonly referred to as deferral, can have its benefits. The question is, do I want to take it now, or do I want to take it later? Transferring income to another entity, such as a corporation, is also another way of managing tax. As in Carl's case, when we own a corporation, we also have choices on the nature of income between salary, dividend, and benefits. Lastly, there are tax shelters and investment accounts available to help us minimize tax obligations. First, we'll consider how to maximize profits at the corporate level. We want to first examine earnings under a corporation by leveraging deductions. This includes things like workspace and home, automobile mileage rates, cost of leasing a vehicle, RPP contribution, and benefits. We'll then look into tax rate breaks offered by the government to incentivize Canadian small business owners. CCPC earning active income is entitled to a small business deduction on the first $500,000 of income. Federal tax rate is reduced to 11%, and the provincial tax rate is reduced to 4.5% for Ontario, making a total of 15.5%, which is a rate that is substantially lower than other corporate rates, and the majority of personal rates, making it very attractive to some business owners to retain income within a corporation for reinvestment. This will provide bigger cash bases, which can lead to significant wealth in the future when considering the effect of compounding. Lastly, we'll look at reinvesting profits through different classes of assets. Different asset classes have specific tax implications that must be understood in order to minimize future tax obligations and maximize growth in corporate investment accounts. For example, property income such as interest is taxable at the corporate rate, plus a special refundable 6.67% of tax, which upon distribution to shareholders will be eligible for a refund of 26.67% to avoid double taxation. It is interesting to know that Canadian non-connected dividends will be eligible for full refund of its 33.33% of tax, while Canadian connected dividends are not taxable. Now that we've maximized the profits within corporation, how can the individual owner benefit from these profits? Owner-managers who run their businesses through corporations can choose to receive compensation from their corporations as either salary or dividends. The payment of a salary is deductible to your corporation, whereas dividends are paid from after-tax corporate profits. Careful analysis is needed to calculate the best mix of salary, interest, and/or dividends for your specific circumstance and lifestyle. When it comes to dividends, a Canadian-controlled private corporation can distribute three categories of taxable dividends: capital, eligible, and non-eligible. The tax consequence to a shareholder who is an individual is significantly different for each category of the dividend. Capital dividends are tax-free. Eligible dividends have a larger dividend tax credit than non-eligible dividends, and therefore a much lower rate of tax for the shareholder. As owner-manager, you can also dictate your benefits package. There are three major categories of benefits you can receive as an employee of the corporation: non-taxable, tax-deferred, and fully taxable. Non-taxable benefits, like the name suggests, are not taxable to the employee, but all of them, with an exception of club memberships, are fully deductible by the employer as compensation expenses against the business income. This results in savings for both the corporation and the individual by allowing the individual to enjoy the benefits that are acquired using pre-tax funds at corporate level. There may also be reduced costs as a result from economics of scale when the services are purchased for a larger number of employees. Tax-deferred benefits are taxed at a later date, which may result in a lower tax rates under the progressive system, especially if payments are delayed until retirement. If the delayed payments are invested on an employee's behalf, investment returns will be achieved on a pre-tax income rather than after-tax income. Unlike non-taxable and tax-deferred benefits, fully taxable benefits are taxed in the current period. Why would an individual elect to take fully taxed benefits? Overall, cash savings can result if two conditions are present. The employee needs the particular benefit and would acquire it in any case from after-tax disposable income if it were not provided by the employer. The employer can acquire the particular benefit at a lower cost than can the employee because of greater purchasing power and financial strength. Now that we withdrew some of the cash from the corporation, how should we invest this to maximize our savings? You can opt in to invest in a non-registered investment account and pay taxes as the investment income is incurred, or you can take advantage of the many tax-sheltered investment accounts available. Here we'll discuss two of the most commonly used ones, the registered savings plan and tax-free savings account. RRSP has an 18% of income earned up to $24,930 contribution limit. It's fully deductible from income tax calculations. Tax on growth plan is none, and it's fully taxable upon withdrawal. The benefit of its return on investment compounds on a pre-tax basis. TFSA, on the other hand, has a $10,000 contribution limit and is not deductible from income tax calculations, non-taxable upon withdrawal, and can be extracted when needed. There is no side effect on income tax benefits such as OAS and GIS. Therefore, it's prudent for those investors to hold investments yielding capital gains outside of the RSP and interest-bearing securities which do not have preferential tax treatment within the RSP. Also, it's a great idea to have any investment offering steady returns inside TFSA. To summarize, we want to utilize benefits that are fully deductible to a corporation and not taxable or tax-deferred for the individual to achieve savings of both the corporation and individual. We want to stabilize the annual income by choosing the appropriate salary level for the current time period and taking out dividends in the future. Profit retained within a corporation provides increased cash flow and could result in greater ultimate returns on investment when considering the effects of compounding. We also want to take advantage of lower future tax rates for the individual. More predictable income levels for future years are always desired. Understand the tax impact for different asset classes to maximize the growth of corporate and personal wealth. Also understand the different tax shelter mechanisms to protect growth of personal wealth. Thank you very much for taking time watching our video.